Welcome to Make Your Money Matter. I'm your host, Brad Barrett. In our show, each and every week, we aim to help you create a better relationship with your money. And today on our show, we're going to talk about the question that many of you have right now, you probably don't even know you have. Whether you're in your 20s or your 40s or even your 60s, right? It's the question of whether or not you're going to pay higher taxes in retirement. Things like your Social Security income, your RMDs, or required minimum distributions, all will likely combine to deliver what we sometimes refer to as this tax torpedo. Many people use that, and we're going to talk about that today. But there are ways to reduce your income in retirement to pay less tax. And I want to go through that today to help you answer that question. But before we get started, make sure to smash that subscribe button, hit the notification bell so you don't miss a single episode. All right, let's get into it. Now, to start off this show, I think it's important to note that for an advisor, a financial advisor like myself here at One Capital Management, working with thousands of clients and being blessed to do so for over 2 decades now as a firm, me personally, nearly 2 decades, I think it's important to talk about this because I think the notion since Roth, came around 25 years ago, right, which I talk about heavily on our show, as you well know, that it's important to note that just because you think you're going to pay higher taxes in retirement doesn't necessarily mean you are. But I will say this, by and large, I do see that most of our clients tend to pay more in retirement simply because of things like Social Security, required minimum distributions, as I mentioned, things like taking income from their tax-deferred investments like IRAs or 401ks. And that's if they don't do what I call the bracket game, and we'll talk about that later. But if the tax-deferred investments, things like your IRAs, have significant value, combining the RMDs with your Social Security, which happens, in your 70s, for example, can result in what we've called, and I've shared many times, and many people out there have called this tax torpedo. Now, this term, tax torpedo, refers to the stacking of ordinary income tax and Social Security tax so that the additional distributions from your IRA could be taxed as much as the highest rate possible. Now, I don't know about you, but I'm not a huge fan of paying more taxes than I'm required to pay. So I think it's important to talk about these. And if you're likely going to find yourself paying higher taxes in the future, I got some great things I want to talk to you about today that you can talk with your CPA about for your specific situation, because you can reduce your income to pay less tax. So let's first talk about Social Security. Now, again, it's unique, and keep in mind that before 1983, Social Security benefits were not taxed. Get that, right? Now, unfortunately, Social Security has been in trouble. We talk about it all the time because people are living longer, and we've heard these stats before, and a big portion of our population right now is entering into the phase of needing Social Security. Therefore, the rules have changed in the past to keep Social Security alive, and in my opinion, I get this question a lot, they will likely change more. And I think it will be because there's going to be changes that have to be made to, again, keep the solvency of Social Security. And if you think about it, it breaks down to very simple math, because taxes in retirement are determined differently than what you use during your accumulation years, as I refer to, or your working years. Because you worked your way up this mountain, right? Imagine that, this imagery, okay? You worked your way up this mountain. Now you're coming down the mountain in retirement to live. You have to understand there's a new set of tax considerations. So this new bracket uses what is called provisional income, right? Now the formula to determine what your provisional income will be is basically summed up like this, okay? You add together half your Social Security, your ordinary income, your capital gains, and your dividends and non-taxable interest. That's how you get your provisional income. Now your CPA will do this for you, your tax advisor, talk with them about this, and you will take that number to the chart that you can look up or your CPA will go through, right? And you look at this taxation of Social Security benefits. You can Google that and you can see this chart, and it'll break it down for you between married, filing jointly, and single. So you want to say, okay, Brad, how do I read this chart? So basically I want to verbalize this here on our show. If your provisional income currently is below $32,000 or less, and you're married and filing jointly, you'll find yourself in that 0% tax bracket. That's my key there, okay? If you find yourself with $32,000 to $44,000, which is this bracket game here, then 50% of your Social Security benefit will be taxed at your income rate. Now, the largest portion that could be taxable is up to 85%. Now, 85% is a lot, but it's not 100%, okay? So don't get scared here, but it's not an 85% tax rate. I want to be clear there. I get that question sometimes, but it's taxing 85% of your Social Security, okay? That will be subject to taxation. Now, keep in mind that the numbers in the table that you'll look up have not changed since 1985, and this is what we call that quiet tax, right? Which is when the government does not make changes with inflation to benefit you. Now, someone in 1985 did not need as much income, as we all know, that we need now, all right? So we have found that a lot of people have found themselves in the lower end of this bracket, whereas more people, I think nowadays, 2023 and beyond, find themselves on the higher end. So we've got to talk to Uncle Sam about this. So get out there and vote, because this is a big deal, okay? But I digress. And this is why I'm a huge believer in reform for this kind of stuff, to keep these things solvent. We got to help out. We got to help us out here instead of penalizing us for saving and doing right over these years. Again, I digress. But if you find yourself in this scenario, then you should be in the infamous tax torpedo phase. And this is where you could see up to 40%, which is the highest tax rate currently that I mentioned, being taxed. Now, here are some strategies I think that are important to talk about today on our show. Again, it's a high level of, for avoiding this quote tax torpedo, are things like Roth IRAs and other tax-free vehicles like that, like health savings account, for example, loans from life insurance. These are all ways you can prevent from being forced to pay tax on your income. So again, having a good plan matters here. And I know I stress this all the time, but there's a significant reason for that, right? So make sure you talk about your Roth or any other of these strategies I mentioned with your advisor, because I think the most important thing is to determine how to maximize your income in retirement to hit those high notes, right? High notes of life, quality of life, right? We have many clients who pay 0% in retirement because they allow their income to stay under the standard deduction and keep the provisional income under the 0% limit. Again, that's a strategy you can go through, but you thought I might have more here, but I'll tell you what, I'm gonna lead on that because Roth really is your way, right? Now, is it for everybody? No. So I think the biggest thing about Roth, and I share this often with our clients at One Capital, is it needs to be looked at from all different angles, from your financial plan to your tax plan to your estate plan and all the way through. So make sure you have a comprehensive plan, because even though I'm sharing here that one strategy, right? One main strategy I should share of avoiding this tax torpedo as an example of having all these things stack up in your 70s, for example. And again, you address for that, all of that actually starts today. Planning ahead starts to help you plan for tomorrow. Plan today for tomorrow. It's important. Hey, I hope you enjoyed that today. If you did, make sure to subscribe to our show so you don't miss a single episode. And always remember to make your money matter.